We talk about the different types of business organization and the type of business. Okay, that type of business or different types of business organization. And okay, this is what we talk about. And you have basically sole proprietorship and a partnership and or corporation. So that's the business structure. So the sole proprietorship, that means that's only one owner. So what means the sole proprietorship? So there is only one owner, and that one owner will be responsible for the company's total debt 100%. So you see this type of business is pretty popular. About 72% of the business are sole proprietorship. So very popular. And so you can see like a restaurant, right? Restaurant, and like a real estate list agency or some small business. All those are sole proprietorship. So when you form a sole proprietorship, there are some good benefits, and also there are some disadvantages. So the good thing is that is to start up, is to manage, and you keep all your profit, and you don't have to pay any business tax. Okay, it's called corporate tax. You don't have to pay corporate tax. And also you have a psychological advantage and the ease of exit. Okay. The bad thing for sole proprietorship is this one, is unlimited liability. So what is unlimited liability? Is you have total responsibility for all your debt and liabilities of the company. For example, you have debt due to that business, right? You cannot get rid of it, and you have to use your personal property and to pay for it. So that means if you lose money due to sole proprietorship, you might have to sell your car and your house and to pay off the debt. So that's the bad thing for sole proprietorship. So you have unlimited liability. Okay, unlimited liability. The other thing, is including risk capital difficult, and you have a limited size, limited management experience, limited life. Okay, so let's take a look. If you start your own business, what would it be? Okay, what would it be? And so you want it to be a sole proprietorship or no? What are some of the 4 factors of production you would need? Right? So you start a business. Think about you need to hiring people, and you need to have money, your capital, right? You have you have to need an office or some part of the land, entrepreneur skills, and the person, not only the person, you need some training and the knowledge. That's for sole proprietorship. Yeah. And another one is called partnership. So the partnership, you have at least 2 owners. Okay, at least 2 owners. This type of business, about 9% of the business are joint ventures. They are partnership. So the partnership, you have two major types of partnership. Okay, so one is the all partners are responsible for management and the financial responsibility of the partnership. And limited partner is that at least one partner is not active in the day-to-day running of the business. They have limited liability. So for partnership, okay, at least one partner has to be general partner. Okay, it has to be general partner. So the partnership is also no corporate tax. Okay, no business tax. The contract between partners spelling out the roles of partners. Okay, what are the advantages and disadvantages of partnership? So similar to sole proprietorship, so the advantage including is to establish, is to manage, no special business tax, right? And the same disadvantage is unlimited liability. Okay, so for general partner or at least one partner of the company has to be, take that unlimited liability. Okay, that's for partnership. Now we have a lot, see like different examples, what fits best with each business. For example, this business, different type of business, and we have corporations, right? Corporations, and so we have a corporation that's third different categories. About 20% of business are corporations. Okay, among that 20%, 74% are profit, for profit, and the rest 26% for non-profit. And so for corporation, it's going to be much complex as to proprietorship and partnership. So corporations set up, they could be incorporate. Okay, let's say a lot of company, some company INC incorporate, right, to form a corporation. And some of the company, they are chartered. Okay, the chartered, that means a document grant the state giving the corporation the right to do business. Okay, we say that's a chartered business. And or your company can raise stocks. You have a shares ownership in corporation. Okay, so why the company issuing stock? Or okay, this is the reason. And to own the stock, you can get dividend. And the most important thing is that if you purchase a stock from the company, so you are the owners of the company. It's not the owner of the stock, but also you are owners of the company. Okay, so the more shares you have, the more voting right you're gonna have in that company. So if you are the largest shareholder, so you control that company. Okay, and also own stock you buy in, hope that price of the stock will increase. So stock price increases will bring you big benefits. So so we talk about the corporation, and most of the corporation, they have shares. Okay, the shares could be two different types. one is a common stock, another one is preferred stock. Okay, so the common stock is a basic share of ownership in a company. So you have voting right when you have shares, and in reality, they run over voting right to someone else with a proxy. You give someone else the right to vote your share of the stock. Some of the companies, they have a classes of the stock, like common shares. You have a class A stock, class B stock, and class C stock, or something like that. Okay, so that means some stock, they have more voting right. Okay, some of the stock, they only have the right to get a dividend. Okay, so the difference between common stock and preferred stock is preferred stock typically no voting right. So they only get a dividend. So preferred stock will get dividend is guaranteed. So when you buy preferred stock, they will have a fixed rate, the dividend rate. So basically is promised. And another one is called a liquidation benefit. So liquidation benefit is when the company goes bankrupt, so the preferred stockholder will get the residuals before common stock. Okay, so we talk about the corporation, right? The corporation, the good thing, and the bad thing. Okay, comparing the previous two different types of forms, a corporation, you needed to, it's difficult to form or set up. Okay, difficult to set up. And the most profound disadvantage is the profit of tax. So the company will pay corporate tax because the company will pay corporate tax. So the profit are taxed. So the corporation are subject to more regulations, and then you have to submit more documents and follow more regulations. And why you still wanted to have a corporation? Okay, the good thing is that the corporation limited liability. So corporation, they have limited liability. Okay, so you can lose the money only limited to what you have invested in that company. Okay, it's not going to relate it to your personal property. It's not going to relate it to your luxury cars and your real estate, or even the asset in another company you create. So that's a good thing for corporation. Corporation has limited liability, but the bad thing is that profit are going to pay tax, okay, the corporate tax. Yeah, so we talk about this for corporation, partnership, and sole proprietorship. Okay, 3 different types of forms, and you know which one has what type of advantage and disadvantage. Okay, now we're gonna focus on corporate tax. Okay, so the corporate tax, you know, we in the United States we have 2 different tax code, and one is the corporate tax, and another one is called individual tax, income tax, so personal income tax. So you have personal income tax and the corporate tax. Okay, as what I mentioned that the first 2 different type of business, sole proprietorship, partnership, they are not going to pay corporate tax. what they pay is only individual income tax. Okay, individual income tax. And so individual income tax is going to say you will file your 1040, right? 1040 forms that to claim your tax return. So what are the income you're supposed to pay tax? The income including your wages and the salary. So basically this is the first type we call W-2. So the money you got from your W-2 form and will pay tax. Other than that, you will pay investment income tax. Okay, those investment income tax including dividend, interest, and profit from the sales of security. Okay, so the profit, we call this part is called capital gain. So sometimes we say income, investment income, including dividend, interest, and capital gain. So this is the profit from the sales of security. Okay, so of course the profit has to be realized. Okay, it's not just a it's book profit, right? Okay, let's we look at the individual income tax. And so we talk about individual income, it's not just for personal, because not individual person is also include sole proprietorship and partnership. So those are pass-through entities. So those two types of business not going to pay corporate tax, but the owner of these two different type of business will pay income tax, right? Income tax. Okay, so for the income, if you receive interest, so we talk about three different types: interest and dividend and capital gain. Capital gain. Okay, for interest income received by individuals from your investment is added to other income and taxed. Okay, so you will pay tax, right? You will have to pay tax for individual income, interest income. And also you have, what about the, we talk about later, the interest you paid. This is the interest you received. So any interest you receive will pay tax, except for, okay, the interest you paid for municipal bond. Okay, so we have treasury bond and a municipal bond. So what is municipal bond? Municipal bond are the state and local bond. So the state or local government, they issue the bond. It is not subject to the federal income tax. So when you have a municipal interest from municipal bond, okay, you don't have to pay tax on that. But for the federal treasury bond, you have to pay tax. Okay, this is the tax on interest income. What about you pay interest? Okay, so you something like you buy a car and then you pay interest, and you buy a house, you pay interest. You buy an iPhone and you pay interest, right? So, okay, so this is the thing you need to know is that for most part of the interest paid by individuals on loans is not tax deductible. Okay, you cannot deduct that from your taxable income. And what I mean is that, and the interest you paid on your auto loan and the interest you paid on your iPhone is not tax deductible. But there is one exception is the interest you paid on your mortgage is tax deductible. So when you file a tax return, don't forget to exclude your mortgage, the interest you paid on mortgage. Okay, now we go the dividend. Okay, if you have investment in stocks or some of the companies, you receive dividend, yes, you will have to pay tax. Okay, the dividend that you received will pay tax. Okay, we call this one, it's called double taxation. Double taxation is the main drawback for corporation. So why? You see the corporation, the first they have to pay the corporate tax, and then the shareholders of the company will receive dividend and they will pay tax on the dividend. So that's called double taxation. Yeah, what about the capital gains or capital losses? Okay, if you buy stock and you sell it later, and so your selling price is higher than your purchase price, that's called your profit. Okay, if you earn money from buying or selling stock, okay, that's you will pay tax on that capital gain. Okay, capital gains. What about you are not lucky and you, let's say a couple of weeks ago, and you lose money, you buy stock and you lose a lot of money. Okay, that's your capital loss. Can you exclude the tax loss from your taxable income? Okay, this is how you can do. Okay, so if you do have investment in stock and lose money, and you can file a form 8949 form and a Schedule D. Okay, and then you can claim your loss deducted from your total taxable income. Okay, the maximum amount from your income is taxable income is $3,000 per year. So so if you let's say you lose money this year, $5,000. Okay, but you file that 8949 form, you can claim only up to 3,000, and then you carry forward the rest, $2,000 to next year's tax. Okay, next year you continue to claim your capital losses of $2,000. And for corporation and corporate income tax, that means only for corporation, only for corporation. So the corporation receive interest. Okay, so the interest received by a corporation is taxed as ordinary income. So any interest you receive when you run a corporation, and you will pay tax on the interest you received. What about you receive dividend? So you are a company and you have extra money invested in another company and you receive dividend. Okay, so that is about, okay, this is the case is 70% of the dividend received by one company from another company is excluded from taxable income. Okay, while the remaining 30% is taxed at ordinary tax rate. So if you run a business or a corporation and you receive dividend, okay, you don't have to pay tax on the full amount. Only 30% of that amount will be taxed. So you will pay tax for that 30%. This is the reason why for a corporation. Remember, we talked about the double taxation. Okay, the company pay corporate tax, and then the shareholders receive dividend from the company. They pay dividend tax, and the company receive dividend from another company, and they pay tax again. So we call this one is a triple taxation. So they already taxed 3 times. So that's why the government think about that, relieve the burden of the corporation and allow those companies to pay only 30% of the dividend received from another company. Okay. So that's 30% is taxed. And so what about the interest and the dividend paid by the corporation? So the company pay interest? Yeah, the interest they paid to the creditors is tax deductible expenses. So that's a good thing. That's why we talked about in the previous lecture, right? We talked about that before, about why you have to use after-tax cost debt. Why you have to use after-tax cost of debt in calculation the cost of capital, right? Because the interest paid to creditors is tax deductible for a corporation. If you are a corporation and you borrow money and pay interest, okay, don't worry, that interest is going to be deducted from your taxable income. However, the dividend paid to stockholders are not tax deductible. So this dividend will go to their stockholders, and the stockholders will pay tax based on their own tax bracket. So the dividend will pay different tax rate based on the stockholders' personal tax bracket. Okay. The capital gains. So the capital gain is for a company if you buy stock and or you some other investment, you gain money, and so that's going to be called capital gains. The capital gains will pay tax. Okay, so before 1987, corporate long-term capital gains were taxed at a lower rate than ordinary income. As is true for individuals. Under the current US tax code, however, corporate capital gains are taxed at the same rate as operating income. So your capital gains, if you have capital gains by running a corporation, so the corporate gain, the capital gain will be taxed at the same rate as operating income. Okay, so another question is about if you have not capital gains, you have a capital loss. Okay, capital loss. So the capital loss, let's say your ordinary corporate operating loss, and then you can carry it back, or you do the carry over, right? So if you have profit during the past 2 years, you can carry back, okay, to each of the preceding 2 years, and carry it forward or the carry over for next 20 years to offset your taxable income in those years. So that's the corporate loss carry back or corporate loss carry over. So we have, for example, we have a corporate income tax table. You can see, okay. And so, for example, in 2014, okay, 2014, Abyss International had a taxable income of 2.5 million. Okay, that's your total operating income, 2.5 million. During that year, the company paid interest on its outstanding debt, which include bank loan and bonds. Okay, they pay interest of 60,000. Okay, so if the company they pay interest, okay, you can see this is a parenthesis, they deduct that interest expenses. So all the interest expenses should be deducted from your operating income. And it paid its common stockholders $220,000 in dividend. Okay, this part of the dividend they paid to their common stockholders. The common stockholder will pay tax on that dividend they receive. Okay, it's not going to be related to the company. So the company's corporate income tax, right, is not going to relate to the dividend they paid goes to their common stockholders. Okay, so we don't need this information. Abyss received 180 in interest from its investment in the debt of other company. So the company, they lend money to someone else or some other company and they receive 180. So the interest you received, 180,000, you will add it to your total income. And it also received 80,000 in dividend from its investment in another company's common stock. Okay, this one, you see the company received dividend from other company, 80,000. You are not going to pay tax on the full amount of that 80,000. As what I mentioned before, you pay only 30%, right? So 80,000 times 1 minus 70%. Okay, that's where you got that 70%, 0.7. So only 30% of that 80,000 will pay tax. Okay, that's the dividend you received is 24,000. Okay, what is the company's taxable income? So the taxable income is going to be your operating income plus your interest received plus 30% of dividend you received and exclude, okay, exclude the dividend you paid. That's your taxable income. Okay. So the last picture where I will show you is that the corporate tax rate around the world. So you want to see why in 2017, Donald Trump wanted to have the corporate tax cut, right? So the corporate tax cut, and so we look at the developed markets. So all those countries, the United States is average the tax rate is 40%, and 2014 and 20%. So that's the highest, almost the highest. You know, that's in Germany 51% in 2000. Canada 44.6%. But now is look at 2014, the United States is the highest, about 40%. Okay, after the tax cut, okay, it's go down to 21%, so it's 21%. Okay, now that's plus some of the state tax is only up to 25%. So now the tax rate is significantly reduced, and to make U.S. firms be more competitive in a global market. Okay, and okay, that's all for today. So we have the okay, week 6 and 7, you have midterm exam and forum and assignment 3. And week of this week 7 and 8, so we have a final exam. So and so I will make that final exam ready. And so by this weekend, so you can complete the final exam by May 9th. And that's all for this course. Okay, any questions?
Not so far.
Okay, so yeah, so if you have any question, and feel free to send me your email, and I will be glad to help.
Okay.
Yeah. Okay. See you. No, we don't have lectures next time. We just, you know, we just, yeah.
Can we have feedbacks on the previous assignments so that we can better prepare the midterm?
Okay, yeah, I would do that.
That would be great. Thank
Mhm.
you.
Okay.
Okay.
Okay, have a nice weekend.
Thank you, you
You
too.
too.
Mhm.
Bye, Candice.
Bye, Day.
Okay, bye.
Bye-bye.
Bye.